MercadoLibre, the company that built Latin America's internet economy. It is the Amazon, PayPal, and FedEx of the region, all rolled into one platform.
Marcos Galperin founded MercadoLibre in 1999 while at Stanford Business School. The original idea was a marketplace for Latin America, a region with 650 million people and almost no reliable e-commerce infrastructure.
It listed on NASDAQ in 2007, becoming the first Latin American internet company to do so. But the real inflection came years later when Galperin pushed hard into financial services.
Mercado Pago started as a checkout tool. It became a digital wallet, then a lending platform, then a point-of-sale network for small businesses across the continent.
By 2024, fintech had overtaken the marketplace as the primary revenue engine. Total revenue crossed $28 billion last year, up nearly 40% year over year.
The flywheel is powerful. More sellers attract more buyers. More buyers fund more logistics capacity. Better logistics enables faster delivery. Faster delivery drives more Mercado Pago adoption. More payments data powers better credit underwriting.
Mercado Envios, the logistics arm, has built out fulfillment centers and last-mile delivery across Brazil, Mexico, and Argentina. Same-day and next-day delivery is now available in major cities.
Mercado Crédito extends loans to merchants and consumers who have limited access to traditional banking. In a region where financial inclusion is still low, that is a structural tailwind.
Brazil, Mexico, and Argentina together account for about 80% of revenue. Each market has different dynamics. Brazil is the largest, Mexico is the fastest growing, and Argentina is complex due to currency volatility.
Currency risk is the most cited concern with MELI. When the Argentine peso or Brazilian real weakens sharply, reported dollar revenue can take a hit, even if local business is growing strongly.
Amazon has tried to compete in Latin America, but MercadoLibre's local relationships, regulatory know-how, and deeply embedded logistics network give it a durable structural advantage across the markets that matter most.
Marcos Galperin has been CEO since day one. He owns a significant stake and has consistently resisted pressure to break up the business, insisting the integrated marketplace plus fintech model is the core source of competitive strength.
The advertising business is also growing fast. Brands pay to reach MercadoLibre's massive audience of active shoppers, high-intent traffic that commands premium ad rates.
Gross margins have expanded as software and fintech grow faster than physical logistics. The mix shift toward higher-margin services is a key driver of profitability improvement.
MercadoLibre operates in emerging markets where the middle class is expanding, smartphone penetration is rising, and digital payment adoption is still in early innings. The runway is long.
The company has roughly 100 million active users across 18 countries. That scale, and the data that comes with it, is very difficult for any new entrant to replicate.
Q1 2026 results are now in, and the MercadoLibre earnings episode is on the way. We will break down the quarter, the fintech metrics, and how management is navigating the macro environment in Brazil and Argentina.
For the full earnings deep dive, the numbers, the macro context, and what it means for the growth trajectory, stay tuned to Charged Alpha.
Welcome to Charged Alpha. I'm Hudson, and tonight we're covering MercadoLibre, ticker MELI, Q1 2026 earnings. Latin America's e-commerce and fintech giant just reported, and Lana, the headline number, is a big one.
It really is, Hudson. 49% revenue growth year over year, the strongest top-line print in nearly 4 years. The market's reaction was complicated, and we'll get into that, but this is a company firing on multiple cylinders.
Let's set the stage for listeners who may be newer to MELI. MercadoLibre was founded in 1999 in Montevideo, Uruguay, and today it operates across 18 countries in Latin America. Think of it as the Amazon and PayPal of an entire continent combined. The core business is a marketplace connecting millions of buyers and sellers, but the company has spent the last decade building an equally massive financial services arm called Mercado Pago.
That dual-engine structure is what makes MELI so distinctive, Hudson. Mercado Pago handles payments, consumer and merchant credit, insurance, and asset management. In Q1, fintech revenues hit $4 billion, essentially matching the $4.9 billion from commerce. This company is not just a retailer. It is becoming the financial infrastructure layer for Latin America's emerging middle class. 82.9 million monthly active fintech users as of this quarter tells you the scale.
So let's get into the actual numbers. Revenue came in at $8.85 billion for Q1 2026, beating the analyst consensus estimate of roughly $8.28 billion by nearly 6.8%. That 49% year-over-year growth rate is a meaningful acceleration from recent quarters.
On the EPS side, the story gets more nuanced. Adjusted earnings per share came in at $8.23 versus the street's estimate of $9.37. That's a miss of about 12%, and it marks the fourth consecutive quarter where MercadoLibre's profits have come in below expectations. Hudson, that pattern matters.
It does. Let's unpack why. Gross merchandise volume, the total value of goods sold through the marketplace, reached $19 billion, up 42% year over year. Brazil GMV grew 38% with items sold actually accelerating to 56% growth. Mexico posted 28% GMV growth, and Argentina added 41%. Same and next-day deliveries hit 199 million shipments, up 39%, which means faster fulfillment is becoming a real competitive weapon.
On the fintech side, total payment volume is being supercharged by the credit business. The Mercado Pago credit portfolio expanded to $14.6 billion. That is 87% year-over-year growth. The company issued 2.7 million new credit cards in the quarter alone. Assets under management in the fintech unit rose 77%. This is not incremental growth. It's a structural shift in what Mercado Pago means to its users.
Unique active buyers grew 26% year-over-year to 84.1 million people. That's a staggering number when you consider how many of these markets are still underpenetrated digitally. MercadoLibre is not fighting over existing e-commerce customers, it's creating them. And each new buyer that joins the marketplace is a potential Mercado Pago user. That flywheel is the thesis in one sentence.
Let's go deeper on the financials. Gross margin came in at 50.7% for the quarter. That's healthy for a platform business this size, but it has been compressing, down from 53.2% a year ago. The company is absorbing higher fulfillment costs and merchant incentives as it pushes for market share in logistics and credit.
Operating income landed at $611 million, representing a 6.9% operating margin. That is down sharply from 11.2% in Q1 2025. Management is explicitly choosing to invest aggressively right now in logistics infrastructure, credit underwriting, and seller acquisition, and that investment is showing up as margin compression.
Net income for the quarter was approximately $412 million, giving a net margin of about 4.65%. On cash flow, operating cash flow was $2.1 billion, which sounds strong, but after capital expenditure of $271 million and net loan growth of $1.9 billion, adjusted free cash flow was negative $56 million. Management called Q1 seasonally soft and not indicative of full-year trends.
Balance sheet. The company held $6.6 billion in cash and liquid investments as of March 31st. Total debt is roughly $12.3 billion, mostly tied to fintech funding. Net debt stands at approximately $5.7 billion, with a net debt to EBITDA ratio around 1.5 times. Elevated but manageable given the growth trajectory and the credit book's income potential.
To put the valuation in context, at the current stock price around $18.70, MELI carries a market cap of roughly $94.8 billion. That implies a price-to-sales ratio near 2.7 times on forward revenues, which, for a company growing at 49% with a dual flywheel model, is not obviously cheap, but it's well below the premiums MELI commanded during peak growth years.
So what is Wall Street saying? The analyst community is overwhelmingly bullish on MELI's long-term story. The consensus rating is strong buy, with 10 strong buy ratings, 7 buys, and just 2 holds. The median analyst price target is around $24.49, implying about 30% upside from current levels. Jefferies upgraded to buy in April with a 2,600 target.
UBS was the contrarian voice. They moved to neutral and cut their target to 2050 at the end of April, citing margin trajectory as the key concern. The divergence among analysts really reflects the central debate. Is this margin compression temporary, a necessary cost of building a 20-year platform, or does it signal that the economics of this business are fundamentally deteriorating? Goldman Sachs and JP Morgan both reiterated overweight calls post-earnings, suggesting the smart money leans toward the former.
Let me walk through the bull case. First, the credit portfolio. 87% growth to $14.6 billion makes Mercado Pago one of Latin America's largest consumer lenders. Credit generates structurally higher margins than commerce over time, and MELI's data advantage, knowing what users buy, how often they shop, how quickly they pay, gives it underwriting precision that traditional banks cannot match. This is not a payments company bolting on credit. It's an ecosystem where every purchase deepens the lending relationship.
Second, logistics is becoming a real moat. Same and next-day delivery hit 199 million shipments, up 39%, and that scale is exceptionally difficult to replicate. Amazon has tried to accelerate in Brazil and Mexico, but MELI's decade of local infrastructure investment has built last-mile advantage in markets where geography makes delivery genuinely hard. Third, the stock is sitting 30% below its 52-week high. Long-term investors are getting a 26-year runway story at a meaningful discount. That combination, fast-growing credit, logistics moat, and a pullback, is why so many analysts remain bullish.
Now for the bear case, and it starts with the obvious. 4 consecutive EPS misses. Markets tolerate 1 or 2 investment cycles, but 4 straight quarters of earnings shortfalls puts management credibility on the line. The operating margin fell from 11.2% a year ago to just 6.9% this quarter. Investors need to see a credible path to margin recovery, and so far, the company hasn't drawn a clear timeline. Without that anchor, the stock stays in a show-me mode.
2 more risks worth flagging: the credit book and currency. An 87% surge in the credit portfolio is impressive until an economic downturn hits. Brazil's growth is already moderating, and Argentina's macro environment remains fragile. A spike in loan defaults would hit the fintech revenue line hard and fast. And FX is a permanent headwind. MercadoLibre reports in dollars but earns in Brazilian reais, Mexican pesos, and Argentine pesos. Every depreciation cycle converts strong local currency growth into softer dollar numbers, and that dynamic is difficult to hedge at scale. These 2 risks together could create a painful quarter if either deteriorates.
Looking at how sophisticated traders are positioned, the options market showed a put-call ratio of roughly 0.82 heading into earnings, which signals a lean toward bullish positioning. Traders were buying more calls than puts, betting on a positive reaction. After the EPS miss landed, that flipped quickly. There was a notable spike in put volume as investors moved to hedge the margin uncertainty through Q2 reporting. The stock slid roughly 6% in after-hours trading, confirming that the revenue beat alone was not enough to overcome the 4th consecutive earnings disappointment.
On insider activity, 3 open market sales by executives over the past 6 months, totaling roughly $12 million. That sounds alarming, but context matters. These were pre-planned dispositions under 10b5-1 plans, set up months in advance. They are not reactive to the earnings release. There were 0 insider purchases recorded in Q1 2026, which is a mild negative signal. Executives aren't putting fresh capital to work at these prices. But the selling activity looks like routine diversification rather than a conviction call against the company. Sophisticated investors usually treat pre-planned sales as noise.
So where does this leave us? MELI is executing at extraordinary scale. 49% revenue growth, 84 million buyers, while investing heavily in its future. The market is split on whether the margin pain is temporary or structural.
This is a conviction story, not a momentum trade. 19 analysts rate it strong buy with a 24.50 median target. 4 EPS misses say the market wants proof. If margin recovery shows up in Q2, MELI could re-rate sharply. Until then, patience is the position.
That's a wrap on MercadoLibre Q1 2026 here on Charged Alpha. If you found this breakdown useful, subscribe wherever you listen to podcasts and drop us a review. It helps more investors find the show. We have more earnings coverage coming all season long. I'm Hudson, she's Lana. Thanks for listening, and we'll see you next time. This content is for informational and educational purposes only. It is not financial advice. Consult a licensed financial advisor before making any investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.